Welcome to the Deep Dive. Today, we're cracking open the Q2 2025 results for MGP Ingredients. That's MGPI. Their call was July 31st.
Right. And our mission today is really to quickly unpack the numbers, what management said, and, the strategy, because this quarter, it's got some real tension in it.
Absolutely. Pure tension is right. I mean, they delivered a solid financial beat, sequentially anyway.
Yeah, they beat on EPS, beat on revenue expectations, but then the stock, well, it closed down almost 4% that day.
So we need to figure out what the market saw, or maybe didn't see, that caused that reaction despite the operational wins.
Exactly. What spooked investors enough to ignore the positive surprises?
Okay, let's start with those headline numbers, the ones that, on paper at least, looked pretty decent.
Sure. So the adjusted EPS, non-GAAP, came in at 97 cents. Now, keep in mind, the street consensus was way lower, somewhere between 64 and 66 cents.
Wow. Okay, so they really blew past that expectation.
They did. And revenue, too, came in at $145.5 million. Consensus was more like $139 million, maybe $140 million.
So operationally, managing costs, driving sales better than analysts figured.
That's the sequential story, yes. Looks good in isolation.
But investors, they always look forward and they look back,
Yeah.
right? Comparing to last year, not just the estimates. And that's where the caution flags start popping up.
That's exactly where those sector headwinds really bite. It's the reality of the spirit cycle right now. Consolidated revenue year over year, down 24%.
Oof. 24%. That's significant.
It is, and maybe even more concerning for the profit outlook, adjusted EBITDA, that core operating profitability measure, it dropped 38% compared to last year, down to $35.9 million.
Okay, down 38%. And the third big pain point you mentioned was margins.
Yeah, gross margin. It compressed, fell by 350 basis points, ended the quarter at 40.1%.
Right. And for listeners maybe not swimming in 10 Qs all day, 350 basis points, how big a deal is that?
Oh, it's a massive alarm bell. A basis point is tiny, 1/100%. So 350 means the margin shrank by 3.5 percentage points versus Q2 last year.
And that signals
Intense pressure. Either they're dropping prices or they're spending a ton on promotions, especially maybe on the industrial side or the lower end spirits. It means those macro challenges are forcing discounts, and that just eats away at the bottom line.
Got it. So the market basically shrugged off the sequential beat because the year-over-year picture confirmed that, well, that painful industry story is still very much alive. Inventory glut, pricing pressure, shrinking profits.
Precisely. It's like the analysts were saying, okay, nice job managing Q2, but those big structural problems impacting 25 and even into 26, they're still staring us in the face.
Okay. But let's unpack the execution too, because they did beat those estimates. That's worth looking at. And this is the first full quarter with the new CEO, Julie Francis, right? She came on in late May.
That's right. And her message on the call was pretty clear. She kept emphasizing a sustained brands-led focus. The strategy is all about accelerating that shift, becoming a premier branded spirits company.
Which sounds like, more than just corporate jargon. It feels like a necessary pivot given the issues elsewhere.
It absolutely is, because the main drag on results, the big headwind, is that distilling solutions segment.
Let's dive right into that. Distilling solutions, that's the bulk whiskey, the contract alcohol sales there plunged 46% year over year. What's the core problem, and how long does management think this pain lasts?
Well, the decline wasn't a surprise, really. It's all driven by what they call brown goods softness. Basically, the whole industry is swimming in aged whiskey barrels right now. Too much inventory.
Okay. And the timeline.
Management was up front. They expect this inventory workdown cycle to last deep into 2026. This isn't a quick fix.
Wow, into 2026. That sounds pretty grim.
Yeah.
So why didn't the stop fall even harder? There was something interesting about their big customers, wasn't there? A stability signal.
Yes, and this is really crucial. This probably put a floor under the stock that day. Management confirmed that essentially all their large strategic customer contracts were either confirmed or amended.
Amended, meaning?
Meaning customers are taking temporary pauses in buying as they burn through their own barrel stockpiles. But importantly, they haven't canceled the long-term deals. The partnerships are intact.
Ah, okay, that's a huge difference. Canceling implies they're switching suppliers or giving up. Pausing means they likely intend to buy again from MGP once inventories normalize.
Exactly. It gives MGP more stability, more visibility for the rest of this year, at least. They're managing through a tough cycle with their partners, not losing them.
And we're seeing the whole industry react too.
Yeah, the TTB data, that's the Alcohol and Tobacco Tax and Trade Bureau, the official source that shows U.S. whiskey production cuts are speeding up. down 28% in the last 3 months reported, which was through April. Everyone's tapping the brakes.
And MGPI is doing that internally too, cutting back on their own whiskey aging investment.
Yes, very much so. Active cash flow management. They cut their target for net barrel inventory put away that's laying down new whiskey for the future down to just $15 to $20 million for all of 2025. That's showing discipline.
Okay, so Distilling Solutions is the anchor. It's weighing things down. Where's the growth? Where's the validation for this new brands-led strategy from the CEO? Got to be branded spirits.
Branded spirits is definitely the brighter spot, yeah. Though the segment overall, sales were actually down 5% year over year.
Down 5%. That doesn't sound great either.
No, but that top line number hides the really important internal shift. Their premium plus portfolio, that's the focus area, it actually grew 1%, pulled in $31.1 million in sales. So it outperformed the segment as a whole significantly.
Okay, Premium Plus grew. Which brands are really pulling the weight there?
It's unquestionably Penelope. That brand continues to have serious momentum, and they're doubling down on it, innovation-wise. That's key to the premium strategy.
Like what? What's new?
They announced plans for line extensions. There's a Penelope Black Walnut Old Fashioned coming, and they're expanding their ready-to-pour, their RTP offerings.
That Black Walnut Old Fashioned sounds interesting. Is that trying to grab some of that ready-to-drink cocktail momentum? Or pull premium drinkers into a slightly different format?
I think it's probably both, right? It taps into that huge consumer trend towards convenience, the RTPs, but it uses the high-end reputation of the Penelope brand name. It's exactly the strategy. Put resources where people pay for quality and convenience.
And we see that focus in their advertising spending too. A&P spend looked like it was realigned quite a bit.
It was, yeah. Very surgical. Total A&P spend was down 41% year over year. Looks like a huge cut.
41% is massive.
But it's not just slashing costs, it's reallocation. A&P as a percentage of premium plus sales, that's actually closer to 25%. And management pointed out that's way higher than industry averages.
So they're sacrificing broad, maybe lower return marketing to really laser focus on the core growth drivers like Penelope and Elmior, presumably.
Exactly. Hyper-focused investment.
Okay, so the premium end is the priority, and it seems to be working, albeit modestly. But if you shift focus upmarket like that, what's happening with the mid-tier and the value brands? Especially in, a tighter economy.
Yeah, those brands are definitely feeling the pinch. General pressure on spending, plus more price competition. The company admitted they're having to use more price support, more promotions there.
And the outlook for those lower tiers.
They actually lowered the expectation for the full year. They now expect sales declines for mid and value to be worse than they thought, below double digits now, whereas before they hoped for maybe mid to high single-digit declines.
Wow.
So yeah, that value competition is fierce, and it's hitting those margins we talked about earlier.
Okay. Let's quickly touch on the third leg of the stool, ingredient solutions. That often acts as kind of the steady eddy, right?
Yeah.
The stabilizer.
And it really was the quiet, positive surprise this quarter. It posted 5% sales growth year over year, showed sequential improvement on basically all metrics, and crucially, they had a strong rebound in specialty wheat protein sales, up 13% in Q2.
Didn't they have an issue with losing some export business there not long ago?
They did, yeah. They lost a significant chunk of volume with a partner in Japan. But here's the execution win. They successfully offset that loss by winning new business with North American customers.
So they didn't just take the hit, they actively replaced the business.
Yeah,
agile.
Exactly. Shows real agility in that division.
Yeah. And operational efficiency seems like a theme there too. You mentioned investments at the Atchison plant and a new biofuel facility.
Yeah, the focus is definitely on long-term cost control and efficiency. They're putting more capital into the Atchison plant, aiming for better product consistency. And that biofuel plant that came online in July, that's a really smart move.
How so?
They're taking the waste byproduct from making ingredient stuff that used to cost them money just to get rid of, and they're turning it into energy for the plant.
So turning a disposal cost into an asset.
Textbook example. Mitigates a liability, creates value. That'll pay off down the road.
Okay, so let's pull it all together. We've got good sequential execution, signs of contract stability in distilling, a successful pivot mostly to premium brands and ingredient solution stabilizing. But the stock still sold off. What did management say about guidance for the rest of the year? Did they cut expectations given that gloomy 2026 outlook for brown goods?
This is where they showed some confidence. Management actually reaffirmed the full year 2025 guidance across the board.
Reaffirmed. Real
Holding firm. Net sales still projected at $520 million to $540 million. Adjusted EBITDA, $105 million to $115 million. And adjusted basic EPS between $2.45 and $2.75.
Okay, but wait. If Distilling Solutions is facing pauses and expected to be weak into 2026, doesn't reaffirming the full-year guidance imply that the second half H2 has to be significantly weaker for that segment?
It absolutely does. And they basically acknowledge that. They noted contract phasing will skew H2 results lower for distilling. So reaffirming the total guide means they must be very confident that Ingredient Solutions stays stable and that branded spirits, particularly premium, keeps offsetting that decline.
I see. It's a bet on the other two segments holding up strongly. I also noticed they trimmed CapEx a bit. Capital expenditures.
They did, slightly. Trimmed it to about $32.5 million, down from $36 million.
Is that another nod to the downturn maybe being prolonged?
I think you can read it that way, yeah. The reduction is mostly about aligning their warehouse investment with current customer demand. Basically, they don't need to build quite as much barrel storage right now.
And trimming CapEx helps cash flow.
Boosts free cash flow generation, exactly. Which the market likes to see, especially in a cyclical downturn. And their balance sheet looks solid, net debt leverage around 1.8x. It's very manageable.
So the story remains this clear split.
Yeah.
The execution inside the company looks decent, stabilizing.
Right.
But that external cycle, the brown goods glut, the margin pressure, that's just dominating how investors see it.
That narrative is definitely in control right now. And it drove the Stark reaction, no doubt.
Okay. Time to shift gears then. This brings us to our This Is Not Financial Advice segment. We like to pitch an outrageous, but maybe plausible trade idea based on these kinds of internal splits we see.
And MGP Ingredients is almost perfectly set up for this, isn't it? It really is like a tale of two companies inside one stock ticker.
How so?
You've got this high growth, potentially high multiple branded spirits business focused on premium stuff. And then you have the cyclical, traditionally lower multiple distilling solutions segment, which right now is just completely weighed down by this industry inventory mess.
Right. And the market is valuing the whole thing based on the noisy cyclical part.
Pretty much. It's ignoring or heavily discounting the underlying value in those brands.
Okay, so lay it out. What's the outrageous trade pitch here? How does it connect to the new CEO's brands-led focus?
All right, so the trade idea is this. You initiate a long position in MGPI, but you're not just betting on the current business turning around quickly. You're specifically targeting the possibility of some kind of corporate restructuring or maybe a strategic brand sale.
Going long the intrinsic value of those premium brands, basically.
Exactly. The idea is that management, especially under a new CEO emphasizing brands, eventually recognizes the market isn't giving them credit, that the stock is being unfairly penalized because of the industrial side's temporary problems.
So they might look to what? Spin off or sell the crown jewels to unlock that value?
That's the bet. You wager that the highest growth, most valuable branded asset, think Penelope, with its amazing momentum, maybe Elmer too gets strategically separated, maybe sold off entirely to a larger CPG company, a big spirits player.
Someone who wants that high-end whiskey or tequila exposure, but doesn't want the headache of running a giant bulk distilling operation.
Precisely. And imagine if they sold Penelope for, say, a premium spirits multiple, 20x, 25x revenue, whatever is plausible in that M&A space.
Yeah.
That kind of transaction, it would instantly unlock a ton of value that's currently just buried under the Distilling Solutions inventory overhang. You get a cash infusion, you get a clean separation of the fast-growing asset. It could force a significant re-rating of whatever's left, the remaining stub business.
It's basically a bet on management doing a strategic cleanup job, driven by the frustration of the market only seeing the cyclical downturn.
It really plays directly into that tension we started with. The internal success versus the external perception connects all the dots, you could say.
Okay, fascinating idea. So let's recap the bigger picture for everyone listening. MGPI, they delivered a sequential win. Operationally, they executed well, showed strategic focus on premium brands, controlled costs. They importantly confirmed their key distilling partnerships are paused, not broken.
Right, that stability is key. But that long shadow of the brown goods inventory cycle and the margin pressure it brings, it's still very much there, and that's why the stock reacted the way it did.
And just to be crystal clear, nothing we talked about today, especially that last segment, constitutes financial advice. This is just our breakdown of the earnings call narrative and the company's recent performance.
Absolutely. And maybe here's a final thought for you to chew on. Management confirmed contracts are paused, not canceled, We know the industry is slamming the brakes on production, down 28% in just 3 months. So the question is, how much longer does that production cut need to accelerate before the market finally decides, okay, maybe we can see the bottom of the pool now? When does the market believe MGP's long-term partnership strategy will actually pay off?
Finding that inflection point, that'll be the key to the next big move in this stock. Interesting times ahead for MGPI watchers.